afternoon, everyone, and thanks for joining us today. We're very pleased to welcome Araxi, which you'll know as formerly known as Capital Appreciation, to unlock the stock. As you know, this platform was created for retail investors to connect with corporate management and to get a better understanding of both them and their companies. Today, we are joined by Araxi CEO, Bradley Sachs, who will take you through the company's presentation shortly. And the group CFO, Sjoerd Duvenacher, will also join us for the Q&A afterwards. Unlock the stock is only possible with our technology partner, Lumi Global. Please visit their website, which is lumiglobal.com, to discover more about their various online AGM and investor presentation solutions. The Q&A session today will be hosted by Mark Tobin, as unfortunately the finance ghost is unable to join us. Before we start, though, just a few housekeeping notes. The company presentation will be followed by the Q&A, as you know. Please post your questions by typing them into the chat box at the bottom of your screen. The event is being recorded and will be available on our YouTube channel soon. You'll also see an email address before we begin the Q&A session. Please take note of it if you'd like to be added to Araxi's investor distribution list. And with that, for me, that's it for now, and I'm going to hand you over to Bradley to take you through the presentation. Thanks, Brad.
Welcome, everybody, and thank you for joining us. I am joined today by Sjoerd Duvenacher, who is our CFO. I will walk through today's presentation, and Sjoerd will join me in the Q&A. So it's a very exciting time for us at Araxi. As Deborah indicated, we were previously known as Capital Appreciation, and we're very pleased to have this opportunity to address you. We have discovered in the past that a number of people are not that familiar with the Capital Appreciation story. So although today's presentation is going to focus heavily on the recently announced acquisition that we put forward about 10 days ago, I am going to walk through a little bit of an overview of our business units so that the pay-at acquisition can be viewed in context. So I will walk through our various divisions. We will talk about our payments business. We will then have a little overview about our software business. We will then address the pay-at acquisition itself, and we will conclude with our group prospects. So Araxi as a business has three divisions, two operating divisions: our payments business, which includes companies like African Resonance, DashPay, HaloDot, Layup, and most recently we announced last week that we are acquiring an 80% interest in a company called pay-at, which is for us a very exciting acquisition. In our software division, we have a company called Synthesis, Dariel, and an investment in a company called AssetPool. We do have operations internationally, and we report that as a separate segment, but those operations take the activities that we do in our payments and software areas and pursue opportunities outside South Africa's borders. So our investment case as a business continues to be very strong in our mind. We have great opportunity for further growth, both organically and by acquisition. The trends that we are seeing in the sectors in which we operate are strong and continuing to grow. We can get into each of those as we go through the conversation. Our opportunity is large. We are a trusted partner to very large, sophisticated, and developed financial institutions, as well as emerging new technology players. We have a base and a team of really fantastic software engineers who have an acute understanding of the sectors and the technologies with which we operate. Our track record, I think, demonstrates the leadership that we have in the areas where we play. We are very focused on building an institution that will be here for the long term. So our investments that we make, not only in terms of a traditional investment, but the investment that we make in our operations, our people, the technologies are very future focused. Our businesses are cash generative. We have a resilient business model, and you will see that the nature of our income is very highly weighted to annuity revenue, which for us gives us a level of predictability that we're pleased about. Our balance sheet has traditionally been completely unlevered. We've sat with large cash balances, which gave us the flexibility to transact as we needed to. Our balance sheet still remains very healthy post this transaction, and we will get into that in a moment. So what did we achieve over the course of the last year? From a strategic perspective, we changed our name. The new branding and the new name has been well received, not only by our institutional investors, but also by our customers and our staff, which we're very pleased about. And we announced the acquisition 2 weeks ago. It's a billion rand acquisition for 80% of the business, and that for us is a really important milestone. Operationally, the payments business has operated extremely well, continues to demonstrate a strong pipeline, and we will demonstrate what that means from a financial perspective shortly. Our software business was having a little bit of a harder time given some of the larger macroeconomic conditions in South Africa, but we undertook a restructuring. Those cost savings initiatives are coming through, and we are starting to see a turnaround in that business. Still some way to go, but we are pleased with the progress that we have made. We have been very diligent in our expense management, and we continue to focus on our BE credentials, and we're proud of what we have done in the short period of time. So overall, from a group perspective, when we reported our results in December, we demonstrated that our normalized headline earnings per share were up 58%. If anybody's interested in seeing that presentation in more detail, I think it's on the Unlock the Stock site. It is also on the Araxi website under the Investor tab, and I encourage you to have a look at that. But you can see very healthy growth in our performance, and we were very pleased with the results that we released in December. We had a stable dividend per share, and that's attributable to the cash generative nature of our businesses. Our payments business, I will walk through quickly. The underlying demand for digitization and digital payments is growing. You can see that on the chart on the left-hand side, and you can see the demand for card-related activities in South Africa being materially higher than it is in other countries, which demonstrates an increasing opportunity in other countries, in addition to the high opportunity within the South African market. What we do in our payments division is we have a turnkey solution around payment enablement at a point of sale with a debit or credit card. We offer these solutions into an enterprise environment. Our primary customers are big banks who then provide that solution to the retailers, and we do everything from providing the device, creating the software, managing the terminal estate, including all the communications that are required for the terminal to engage with the bank's backend. And our real distinguishing characteristic is our capability around software. What that has meant in the top left-hand quadrant is a growth in the terminal estate that we have and manage from roughly 50,000 to almost 500,000 as of September last year, and that continues to grow. Our EBITDA margins were strong, our annuity revenue was up, and we have a diversified revenue stream. So a very strong foundation in our payments area, which is why we continue to invest in the payments area, of which Payat is an example. Financially, you can see the growth that we have experienced, and we are pleased with that performance. and anticipate continued good performance going forward. We have a very deliberate and articulated growth strategy, which we have spoken about many times. We have grown our market share we've grown our estate as you've seen, and that's as a result of taking market share, not because the South African retail environment has continued to grow and flourish. So we're very pleased with the overall performance of this team and what they have done. We are forward thinking, and so as we have explored opportunities both for investment and acquisition, we have a phenomenal base for future expansion. And one of the most important is we are very innovative in how we think about payments overall. Halo Dot is an example of that. This is a technology that allows any NFC-enabled device to become a payment acceptance device. And why this is important is that different use cases require different types of devices. And when you have the cost of a device being an economic barrier to financial inclusion, this helps address that hurdle. And we have a number of implementations currently underway. You can see the dots on the map on the left-hand side. So the application of Halo Dot has universal applicability globally, and we are recognized as a leader in this space, having been certified on something called the PCI MPOC standard, which is we're only one of a few around the world who have achieved that. With this technology, it is built in a very modular and progressive way. And while it first started for deployment across Android devices, we are now certified for deploying it in the Apple ecosystem, which is a tremendous accomplishment and something we are proud of. And Apple's decision to get into the sector, we think, is a good tailwind for soft POS deployment globally. In our software division, we have two companies, Synthesis and Daryl, and we have a quick diagram showing the areas of expertise in which we play. The two businesses each have a record of over 20 years of expertise and activity with large institutional clients who operate at scale, and we are quite pleased with their overall capabilities. We focus on the financial services sector, although we do have activities in retail, telco, hospitality, and healthcare. And we bring some really great knowledge and capabilities around AI and intelligent automation. One of the areas that we've recently expanded to, and you'll hear this as a buzzword, is agentic AI and generative AI. And we are deploying some very interesting projects in those areas, both in retail banking and also in banking infrastructure. For instance, we have profiled in the past a use case where we are using AI to detect and prevent fraud. And Capitec is one of our customers, and they are in print saying that they have saved more than 300 million rand already with the deployment of this AI solution. So some really great capabilities. We have won a number of accolades and have been recognized for our capabilities. One that we're particularly proud of is we were voted the best software house in South Africa by My Broadband and My Broadband readers in 2025. And there are a number of others that we couldn't even fit on this page. But the team is very accomplished with some great capabilities. The software division's performance was a little bit spotty. As I said, we had a bit of a hard time, but we implemented a restructuring, and we are starting to see some underlying improvement in the performance of the business. And you can see that reflected in the very right-hand bar on the bottom right chart. So while we weren't pleased with the overall performance, we are pleased with the progress that we've made in driving this business. So with that as context, so that you have a sense of what we do within Araxi, I can now turn to the acquisition of Payat. What we have done is we have acquired 80% of the shares of Payat. It is costing us R1 billion. We are funding that with 200 million rand of cash, which we have on our balance sheet, and we are borrowing the rest in senior debt, and as Stuart has discussed in the past, on very attractive terms. So we're pleased about where that is. The gearing post the transaction remains modest, and we will have a company where the remaining 20%, we own 80%, the remaining 20% will continue to be owned by two existing shareholders who are well-respected business leaders in the Stellenbosch area. They were convinced that the business still had enormous opportunity and value in it and were not prepared to sell. So we are delighted to have them as partners going forward. They sit on the board of the company presently and will continue to be on the board of the company going forward. The management is going to continue to stay with the business, and we believe that this will have a marked improvement on the overall performance of our software division, of which it will form part within the Araxi group. And from a financial perspective, it is expected to be accretive to earnings in the first year. When we look at the effects of this transaction, pre-transaction is the top two donuts. The post-transaction are the bottom two donuts. You will see how much more heavily weighted into payments we are than software. But we are very pleased with the overall performance and portfolio of businesses. From a pro forma basis, the business will generate more than 1.5 billion rand in revenue. We will have a pro forma EBITDA of a little under 500 million rand. It is up approximately 40%. Our margins continue to be good. This is a good acquisition for us, and as we indicated, it will improve our EPS and our return on equity metrics. What does Payat do is a good question. I am sure that many of you, without even realizing, have used Payat. It's not a household brand that you generally think of around payments. It's not a Visa or a MasterCard or something like that. But it is underlying technology that helps you accomplish a lot of the payments that you've made. So if you've ever walked into a Pick n Pay and paid your DSTV bill, or done the same through one of the banking apps that you already have on your handheld device, whether it's Nedbank, Absa, Capitec, FNB, all of them have the embedded capability for bill payment. That infrastructure and technology is the Payat infrastructure. If you have paid a traffic fine at a ShopRite, you have used the technology. If you have gone to a PEP store to receive money using a PIN code, that too is the Payat technology. So it is a technology which is an enabler. It is behind the scenes, it's infrastructure, and it is exceptionally ubiquitous and powerful. So what this ultimately does, it is a company that benefits from network effects. And what is that? It has a broad retail distribution, and it has a number of billers or commercial customers who want to make that infrastructure available so their consumer customers can pay their bills. The more billers we have on the platform, the more attractive it is to retailers who like to get feet in the store. The more networks and retailers you have on board, the more attractive it is to the billers. And so this becomes a virtuous circle, sometimes known as a flywheel, and you can see the broad range of networks where the technology is available across retailers, third-party apps. We accept card payments, we accept cash. It's available through online banking, and it is also available through MNOs, which are cell phone operators. And the nature of the bills that you can pay, here are just some of the examples on what is available. Very importantly, this business has an infrastructure which is 99.995% effective. And that is critically important when you make a payment. You want to know that there is a high degree of certainty that the payment has been made and that your account is credited. So in terms of the overall expanse of the network, there are over 9,000 retailer locations with over 150,000 mobile points or endpoints available for transacting. And because we are embedded in mobile apps, there are millions of mobile apps that have been downloaded that already embed the Payat software, which just gives us a phenomenal foundation and base upon which to grow and through which to innovate and deliver new services. So we think that this infrastructure and expense is almost you can't replicate this very easily. So we think it is a really unique asset with unique capabilities. In terms of its financial track record, you can see the long-term growth, which is the thin black line over a 5-year period. And what you will also see is that in the most recent 2 years, the darker line indicates the rate of growth that the company has experienced. And so there has been an acceleration in the activity. Some of this is a result of movement to more digital solutions, but it is also a recognition of the growth in opportunity that exists. And we think that this is a very good environment in which to invest. The company generates revenue as a result of 2 primary factors: the transaction volume, so the number of transactions that are conducted through the network, and then also the value of the transactions that are conducted through the network. And so in the context of a tough economic environment, we think that it has a very defensible business model that will stand us in good stead. Geographically, the company is not only focused on South Africa, although the vast majority of the activity is in South Africa. It has operations and provides for payment services in Namibia, Botswana, Zimbabwe, and Eswatini. And we are focused on the expansion of this footprint, not only across Africa, but we think there are opportunities in other jurisdictions, and we'll work with Payat to pursue those. So from our perspective, we thought that Payat hit all of the criteria that we identified in the past as being important for us as part of our investment thesis. We were often questioned as to what we're going to do with the cash that we had on balance sheet, and we indicated that we were always focused on acquisitions, but we would only do the right one. We think this is one of the right ones. We continue to look for others as well. The business is a scale business, as you can see. It is cash generative and additive to our business with very good EBITDA margins. It is a differentiated offering given its retail and network footprint that it has. It is in the same industrial sectors that we operate, so very complementary to our portfolio. There is very little overlap between what we do and what Payat does. We do have a commonality of customers and clients, which for us is very good. We think it has demonstrated a lot of growth, but we think that there is continued growth opportunity within the technology set. The business is cash generative. The management team is excellent. We are very pleased that they will be staying with us. The business is enterprise focused. We are not focused on consumers per se, and we believe that this is an area where we can add value, and I will get into that in a moment. And ultimately, we think that this business was very well priced from our perspective for a number of reasons. And the multiple that we agreed to pay is a low single-digit forward EBITDA multiple, and so from our perspective, that is good. The opportunity for continued growth, we see this in a number of areas. One of the places that we think that there is tremendous synergy is with our technology capabilities from our software division in enhancing some of the Payat systems capabilities, platform for expansion, and we will be doing that in the months to come as soon as we get competition approval to proceed with the transaction. The business is focused on financial inclusion, which is an important element of the South African economic landscape and other emerging markets. We believe that this is a platform upon which we can grow. There are opportunities beyond just bill payment in areas like e-commerce and software as a service, banking as a service. There are a number of new entrants into the South African market who need the infrastructure to be connected to retailers and consumers, and we are committed to providing them with that capability. Most importantly, this technology is scalable. It is developed in a very forward-thinking way. The opportunity that it unlocks is an economically resilient one. And so overall, the business model is one that we think has flexibility and is consistent with the Araxi investment thesis. The client base that Payat focuses on is very analogous to the client base that the Araxi businesses today focus on. Big institutions, retailers, banks, financial services companies, and it has developed a good reputation, as I believe we have too, and we believe that that provides us with an opportunity and a platform for further growth. As I've indicated, we believe that the distribution network is very difficult to replicate, and will allow us to deploy new solutions through these endpoints that are additive not only to our banking customers, but also the retailers and the network providers who are part of the Payat system. As I indicated, there is the network effect, and we believe that together with the network effect, there are network economics that result, and there is an opportunity for us to benefit from that as we grow the capabilities within the Payat ecosystem. We will be growing this internationally beyond the South African borders, and we have some really fantastic technology skills within our synthesis and Dariel business that we will bring to bear in the Payat environment. And lastly, what this does give us access to is a huge amount of proprietary data. One of the areas where we have real unique expertise within synthesis is in what we call intelligent data. We will innovate against that data set to develop new products and solutions, and are pretty excited about what that portends. So overall, our group prospects in light of this acquisition, I think, continue to be fantastic. The thesis that we laid out previously is completely consistent with the Payat acquisition. We have a broad range of acquisition opportunities and organic growth ones, which we will continue to pursue. We have a good balance sheet to be able to continue to invest in the business, both organic activity as well as by acquisition. We will be very discerning as to what we elect to invest in. The economic environment in which we're operating is a challenged one, as I'm sure many are aware, although people are talking about green shoots and we are seeing some economic life. So we will take that into account as we continue to consider what our investment philosophy is. And we are seeing good activity across our businesses. So overall, we are quite enthusiastic about where we stand. We think the Payat acquisition is a really good one for the group. We think it adds tremendous synergy to the overall opportunity set, and as I indicated, the business will be accretive to earnings in the first year. So with that, I am happy to turn it over to Deborah and Mark for the Q&A, and Stuart will join me as we go through the questions.
Thanks very much, Brad. That was a good level of detail about the acquisition. Very exciting for you guys. We're now obviously going to start the Q&A, and a reminder to our audience, please, just to add your questions to the chat box at the bottom of your screen if you haven't already done so. Mark, over to you.
Thanks, Deborah, and welcome everybody to today's session. And thanks to Brad for joining and Stuart for joining us once again. Brad, one thing I just wanted to touch on quickly that wasn't in the deck here, this acquisition and what it might mean for dividends moving forward. I know you don't have a specific dividend policy, but Araxi has quite a nice history of dividend payments for a JSE small cap. So maybe if we could just touch on that out the gate.
Yes, thank you, Mark. We have had a pretty healthy dividend that we have paid as a result of us having cash on balance sheet, as well as our business units being cash generative. With this acquisition, excuse me, that doesn't change. Our portfolio continues to be cash generative. We still have a good 100 million rand of cash, and because our businesses generate cash, we expect that to increase. So although we don't have a fixed dividend policy, we expect that we will continue to pay a dividend.
Okay, I think for the retail shareholders on here, I think it's important just to touch on that point. Question from the audience here: stepping back from the acquisition, they kind of want a sense of, was it something opportunistic? Did the vendors approach you, or is something that's been going on for a longer time? And is this part of a broader strategy, they say, to consolidate distribution across African payments infrastructure? I think you did slightly touch on that, towards the end of the presentation. But maybe if we can get a sense of how the transaction eventuated and where it fits now as we look forward.
So there have been only a handful of really scale operators in the payment sector in South Africa. So Payat as a company was well known to us for a long time. One of our business investments, Layup, uses the Payat infrastructure for acceptance of lay-by installment payments. And so we have had a pretty good understanding of its operations, its economics for quite some time. The opportunity to invest and acquire Payat was presented to us quite a number of months ago, and we spent a fair amount of time with the management team and the exiting shareholders in evaluating the opportunity. So it's a business we understand well. We had spent a lot of time considering it, and are pleased that ultimately we were able to secure the transaction.
And this might be asking how long is a piece of string, Brad, but given the transaction is now announced, but I mean, there's a lot of regulatory approvals that need to happen here. Obviously, you're operating in a very regulated space, and from regulators in other jurisdictions. Have you got even a rough sense of when you think this will actually close? Would the final quarter of 2026 be a reasonable estimate at this point?
No, Mark, interestingly enough, we think it will be a lot sooner than that. We are well down the path on the regulatory approvals. There are only two major regulatory approvals we need. One is we need the competition approval, which is, given that the size of the transaction is standard, not because there's a competition issue per se. So we've already filed our application with the competition authorities around that, and expect that will not be too much of a problem. The second is we are going to need shareholder approval. So we are working with the JSE to finalize a circular which will have all the information in more detail about the company, historical, strategic rationale, etc. And as soon as we get JSE sign off, we will distribute that to shareholders and have a meeting. The other regulatory approvals that you would think of in a regulated industry don't really apply here. And if they did, given that we already operate in that environment and we have all of the certificates in our payments area already, we would not have anticipated that to be a problem.
Just a question on Halo Dot. It's been a product that's been talked about for a long time. The question is around, as part of this acquisition, should we expect Halo Dot to be, more prevalent in terms of its contribution to earnings as we move forward?
So there is nothing specific in this transaction that is a catalyst for Halo Dot. Halo Dot is on its own trajectory. It is doing very nicely. You can see from the charts that we put up the number of implementations that are currently underway. As soon as those implementations are complete and the solution goes live in those markets, it will start to generate more revenue. We think that the next financial year will be a time where you will see a more meaningful contribution from Halo Dot, but it is unrelated and independent of the Payat acquisition. There are areas where we could maybe integrate Halo Dot or Payat into each other so that there are more points of presence where the solution is available, so it gets to this notion of ubiquity. But they are two very independent products.
Okay. I might throw on to Sword here, since he is joining us. On the debt, we were talking offline just before we started. A quite good environment to be raising debt currently, with South African government bonds down 330 basis points from kind of 11% to just under 8% this morning after yesterday's budget. And obviously, what happens at the sovereign level filters down into the rest of the economy's debt structure, corporate debt being one of those. Kind of two questions from my side. Fixed or floating over the next, I think, 5 years has been kind of set out as what this debt will kind of amortize over. And then secondly, is it going to be a straight loan from Araxi's current banking provider? Are you going to do a corporate bond and get some competitive bidding in there, or a club facility among a couple of other banking providers maybe?
Yeah, so thanks Mark, for the question. So what we've done is we've really relied on our existing relationship banking partner. So hopefully we'll disclose, or can disclose, the name soon. they've really committed to the relationship and the long-term nature of the relationship. We've never had to borrow money as Araxi, obviously. So it's a step into new territory. But despite that, it doesn't mean we're not well accustomed to accessing debt markets, etc. I think what we were really pleased with was the commitment shown by our banking partners, and as such, we have secured a facility over 5 years, so it amortizes over 5 years. Certainly, the way that interest rates are moving at the moment, we're not going to fix anything for the time being. So it would be floating. And I think just from a cost of debt perspective, it's really on the front end or most competitive side of pricing in the market at the moment. So we're looking at well below 9%, just as kind of an absolute term, but it's obviously currently priced on a 3-month JIBAR plus a margin, but the margin is really competitive. And I think importantly, and I keep mentioning this, the debt will be tax deductible, which is really important as well, just from a cost of capital perspective. So, yeah, we haven't gone. I think, I mean, this transaction has moved fairly swiftly. So we given the commitment we've had from our banking partners, we didn't see the need to go too far and wide and run kind of major auction processes or even access the bond market, etc. We'll reassess in time, but certainly for the time being, we're really pleased with the outcome of the funding.
Brad, I mean, there's the pay at Araxi tie-up now. We've seen Capitec and Wallet.com come together. Bank Zero and Gasaka, which is the Easy Pay kind of brand, sits under their stable. So we've kind of got 3, I would say, kind of main players, and there seems to be a lot of consolidation happening in this sector because all these deals have kind of happened in the last, let's say, 18 months or so. But the Araxi pay-up one is slightly different in that there's no kind of banking license or provider as part of the deal. Maybe just the pros, cons of that, not being part of the full banking license, or what that means in terms of Araxi pay-up competing with these guys who have got a banking license kind of behind their offering as well.
Well, we think that it's important to stick to our knitting, Mark. We are a provider to the banking industry, and we include almost every single bank in South Africa as our client or customer, depending on the sector where we provide solutions. We are not looking to compete with our customers. We are looking to enable them, and our technology has always been viewed, whether it's in our payments division or our software division, as enabling technology to allow our clients to do what they do better, quicker, cheaper. And in this instance, this is another example of that. We enable the banking institutions to include bill payment as a function within their banking app. We enable the retailer to accept payments at a point of sale. So we are not looking to compete on traditional banking products. And from our perspective, we don't need a banking license to do that. I also think that having a banking, and this is Bradley's now personal view, I think a banking license adds a level of regulatory overhead and oversight and burden and cost to a business, which we don't need in the services and solutions that we offer. So we have no intention of looking for a banking license and getting into areas where we compete with our customers.
In terms of cross-sell and synergies and cost savings, obviously they have had their own development team. You've got the software division on the other side. They can be brought together, but can you just maybe give us a sense of bringing the two together, how that can enhance and deepen the relationships further with some of the customers. For example, all the retailers that Payet has, relationships with, obviously that probably opens a few more doors for the layup product, just as, something off the kind of top of my head.
Yes, so Mark, this is an opportunity of incremental and enhanced growth, not one of cost saving. So within our payments division, we have a technology team. Within a layup, we have a technology team. Within asset pool, we have a technology team. So the Payet technology team will continue to remain there, focused on the Payet solution. We do not anticipate transitioning the Payet technology to our synthesis or Dariel teams. But what we do anticipate is that the level of expertise and technology prowess that exists within Dariel and synthesis is at such a level that they will be able to be helpful and additive to the Payet technology teams to enhance what they already have. And so that's where we think there will be some opportunity. There are opportunities around fraud detection. We have a really fantastic solution that we've already deployed within 2 banks in South Africa. I've mentioned Capitec as one, and they've been public about that. So they are one. There is another large one that is using our solution. We will deploy that within the Payet ecosystem, and we'll get the benefit of that as a solution. Our expertise in cloud allows us to help modernize some of the Payet infrastructure for international expansion. So we'll get the benefit of that. But this is not about replacing any Payet technology team with synthesis technology members. This is about growth and opportunity as opposed to synergy being a code word for redundancy. That is not the case at all. Mark, you're on mute.
Excuse me. Another thing you touched on in the presentation was, the revenue of the payments business and its contribution to the group post this transaction. Obviously, it's going to be increasing. But given payments is a scale business, because you're taking such a small transaction fee or percentage or whatever way it's worked, you need huge scale. I think it's 60 billion, I think, that Payet runs over its rails. How does that then flow into, if we take the payments division as a whole, in terms of margins on if we take a 3-year view out, does this incrementally help margins in the payments division, given now there's a huge amount more volume going to be pushing through the division with Payet coming in?
So thank you for mentioning the value of transactions that are processed through the Payet infrastructure. As you mentioned, I realized I neglected to mention it in the presentation. It is sizable at 60 billion rand in the last 12 months. You are correct. That is a scale business. That type of scale and activity is independent and unrelated to the nature of the activity that we deliver in our payments business today. So the scale is not additive to each other, but what it is additive to is the industrial investment that we make in the area around payments, and the investment that we make in our client and customer relationships. So the margins within Payet are very good. Overall, the margin is better than our payments business. So we view the result of the combination being additive, but not because scale in one payments business added with the scale in Payet results in any margin upliftment. It is just the balance of the two. So we think that the two will continue to perform very well with very attractive margins, with good growth prospects going forward.
Sure, I've got another question for you that's just coming here, just around going back to the debt again. Somebody just looking for a sense of, where it's going to land in terms of interest cover or net debt to EBITDA, or kind of a lot of this kind of metrics we see around maybe covenant reporting or whatever you want to call it being disclosed by companies who generally tend to have debt. Can you maybe just give us a sense of a few metrics? I know it's hard to do without the most current results, but if we even give a rough idea of where you think it should land.
Yeah, so I think when we talking about covenants attached to the debt, I think gives us still a lot of headroom. So the overall it does come down over the maturity of the debt, but initially will be, I think, around 2.25 overall net debt to EBITDA being the covenant. So as you can see, that would give us substantial headroom still within the debt. We haven't disclosed, I suppose, given the last 12 months or even based on the interim results, where the post-transaction net debt to EBITDA would be. We have mentioned that based on the 31 March 2025 results, we would still be below 1.2 times net debt to EBITDA post-transaction. So I think, yeah, safe to say that rolling that forward will still be well below 1.5 times. By the time the transaction closes. So yeah, still very modestly geared.
And I think, yeah, just to mention, the upcoming result in probably won't capture any of the PAS numbers. We'll have to wait till the reporting period on from that, so people are trying to work it out. Maybe wait till it's actually in the numbers and then go from there, because it is going to have quite a big swing.
Yeah, correct. The results that we issue in March will not include any PAT contribution at all.
Yeah, and probably only a part. Assuming things keep moving at a pace, Brad, it'll only be a partial inclusion when we get to the ones that come out in September or November. Sorry.
Correct. So
and
Mark,
sure,
the one thing I wanted to
is
just mention that I did mention, but I want to reiterate, is the management team at PAT today are excellent. It is their handiwork that we're seeing reflected in this performance, and we are delighted that they are going to be sticking with us. We have spent a fair amount of time looking at the employee base at PAT, and they have an excellent cohort of people. And so we are a people business at the end of the day, and we think culturally there is great alignment between the PAT team broadly and the Araxi group broadly. And so we welcome all of those new faces to the Araxi family, and pleased to have them part of our journey.
Yeah, and then as a recovering CA, I will say as well that 80% of the business, that means everything is going to get fully consolidated in the accounts with a minority interest adjustment below the line. So people should also keep that in mind when they're working out the net debt to EBITDA numbers as well. Brad, one final question here. It's around, obviously PAT increasing the size of the payments division. The question is around, is software then still core to the group as opposed to having a purely focused payments standalone business? So
we are not anticipating shedding the software business. We think the software business is a really good. It gives us a competitive advantage. It delivers huge value to the customers that it serves. I can break some news today. We were just awarded a new credential within the AWS ecosystem. I won't reveal what that is, but we will make an announcement in the not too distant future. The capabilities that we have within our software division are truly world-class. We have had a little bit of a tougher time of it, but it's not because of anything within software. It's more as a result of some of the economic conditions within which we're operating and the willingness of customers to make some of these forward-thinking investments. But we think that with a little bit of passage of time, we have taken remedial action to try and address that. So hopefully the software division will earn its stripes and regain its momentum, and therefore be a bigger contributor to the business than it is today as a result of its improved performance. But that's not going to happen overnight. But to answer your question directly, Mark, is we continue to believe in the software business and the advantages that it will provide us going forward.
We are just about up on time, and I don't see any further questions in my DM. So I'll just hand back to Deborah and say thanks to Brad and Stuart for joining us, and let her wrap up.
Indeed, thanks, Mark, and definitely thanks to Brad and Stuart for making time to support the platform once again. Best of luck with the journey forward. It sounds like it's going to be really exciting. And we hope that all our investors who joined us today found some value in that. So on that note, just a quick reminder that on Tuesday, the 12th of March is our next session, and that will be with Weaver FinTech. And of course, if you missed any of today's session or you want to catch up with anything else, our YouTube channel is up and running, and we'll be posting the video of the session too soon. So, and that's all from my side. So thanks very much, everyone.